Hello, this is Jordan, and this video is being recorded on Tuesday night, May 31st. Thank you so much for joining me today. You're probably watching this on June 1st, and I wish you a great month of June. And in this video, I am going to talk about why and how oil can be an indicator for the gold stocks, focusing more so on technicals. Fundamentally, we know that oil is a huge factor in the rate of inflation, and oil and diesel specifically for gold producers, especially producers who have open pit mines, it can be 30% to 35% of the cost. Less so for underground mines, but it's obviously very important in a micro and a macro sense. And it's interesting because on a secular basis, oil and gold stocks, they're all going to trend together if we're looking at 10, 15, 20-year trends. However, within those trends, I mean, there's periods when oil is very, very cheap, and that's good for the miners, but also periods when it is too strong and commodity prices and inflation is too high. So that hurts gold stocks. So I'm just going to go over a couple of charts here. So we have oil at the top, we have gold stocks at the bottom. That's the Huey Gold Bugs Index. And the vertical lines are points where oil actually put in a peak and then gold stocks put in a bottom. And there's three significant ones. I mean, you can look at the most significant, you can say at this point, you can say 2018, the summer of 2018, the end or towards the end of 2000, November 2000, when gold stocks bottomed after a awful bear market. Oil put in a peak. It didn't surpass that for several years. And then also you had 2003, oil put in a peak there, and gold stocks made a low. It was a significant low because gold stocks really exploded. But, if we're looking at the mid-2000s, they both trended together. Gold stocks made a huge move middle of 2005 to the middle of 2006. And then also late 2007. And if we're looking at that period, call it mid-05 to late 2007, oil moved up, but it didn't move up that significantly. 2003, 2004, that was really the biggest move for oil in that period. And then, of course, 2007 and into 2008. So looking at that period, for the most part, the two trended together. Same thing can be said in the 2008 to 2011 cyclical commodity bull market. Then oil fell apart in 2014. Gold had already fallen apart at that point. But we can see more recently, if we look at it's not just now, but it also happened 2016 to 2018. You can see oil was rising when gold was correcting, gold stocks were correcting in 2017, 2018, and we're seeing the same thing now. So this could be setting up where oil puts in a peak around the time that perhaps gold stocks bottom, or around the time when they start to make a real leg higher. And that could be for a variety of reasons. If we get commodities rolling over, which obviously includes oil, inflation is going to be coming down, and the bond yields will probably be coming down, and so the Fed could be closer to shifting policy, or who knows, maybe they will already have shifted policy at that point, and oil rolling over will signal that there's a recession and they need to cut rates. So we don't know the reasoning, but it could be something like that. Now, technically, for oil, oil looks like it has some resistance here around 110 to 115. Oil looks like it's breaking out here. I haven't looked at the daily chart. I think it's looking better the last couple of days. But if oil can push higher here, then it has a lot of room to move from 115 up to 145 to 150. So that's pretty significant resistance. That could be, if oil were to make that kind of a move over the next couple months, that could be oil a final move in this huge trend for oil where it runs up to 150. It causes a recession. Oil peaks and rolls over. The Fed has to shift. Gold stocks, bottom and turn higher. In that sequence of events. So something like that. But I think that there is a chance here that whenever oil does peak, that could align with a significant low in the gold stocks. So it's definitely something to keep in mind. And obviously oil is a huge factor as far as inflation calculations. And the market looks forward. The market discounts in advance. So if oil rolls over, the market is going to price in a softer Fed, et cetera, et cetera. Now, I'm not saying oil is going to roll over immediately. It has a lot of momentum behind it. And if it's breaking out and it can run above 115 here, it has a lot of blue sky up to 145. So I'm not saying this is going to happen tomorrow and the next month, but it's just something to keep in mind. Last thing, this is a great chart from Jay Koppel. I hope I'm getting his name right. You can follow him on Twitter. You can check my liked tweets. I liked a couple tweets of his. He's with sentimenttrader.com. Great service, great information. Now this chart shows the crude oil term structure, and so they're looking at the difference between, the price of oil in the near term, the near term contracts versus the long term contracts. Oil is in backwardation, which means that the price, as far as near term contracts, is higher than the long term contracts. And so the indicator here is showing that there's quite a bit of a spread between the current oil price, the near term contracts versus the long term contracts. And so based on this indicator here, we could see, it's not the best chart in my opinion. I think they could have done a better job showing this. But those red dots show when the term structure, the bottom half of the chart, they show when the term structure was at this kind of extreme level. That's happened, I think, 5 other times. And really oil, the months ahead after the term structure hit these levels, oil really cooled off, corrected. The only time this didn't come to pass was 2004, and the reason for that was because oil was on the cusp of a major breakout. I think it was a 25-year breakout when oil broke above 40. So that was the only time this did not, give you that signal that oil was going to eventually reverse and come back down. And we can look, the median returns 3 months later, the median return minus 13%, average minus 14%, 2 months later minus 12%, 6 months later minus 8%. So, 1 year later, similar readings. So at some point in the next, quarter or two, perhaps we could see oil peak. And I think if oil were to make that breakout above 115 and run up to 145, that would only increase the chances that oil is getting close to a peak. So just my thoughts on oil. Obviously, it's had a big impact on the miners, as has the fact that gold and silver prices are down. Miners are getting squeezed on both sides. So watch oil, because when we see a shift in the oil market, that's going to be a positive development for the gold mining sector. And I think, there's also implications for inflation and Fed policy there. Let me know what you think in the comments. Thank you for watching, and I'll talk to you guys again in the next video.